If you want to take a look for yourself, the testimony is titled Semi-Annual Monetary Policy Report to the Congress. This is because Jerome Powell stated his testimony towards the Congress, meaning he explained his perspective on the US economy and the overall monetary policy that will be implemented. As you can see here, there are a couple notable data as it might be an indication of the overall financial market movement. The first data he stated was the economic data of the United States. Overall, Jerome Powell stated that the economy is getting better. One of the highlighted data is that the gross domestic product data, which rose around 2.5% in 2024. The GDP, or the gross domestic product, is the overall indicator of the economy, which means if the GDP rises, then the overall economy condition should be getting better. Another data that he highlighted is that payroll job gains average 189,000 per month over the past 4 months. This means that the employment condition of the United States is getting better, as payrolls are increasing, indicating that they are hiring more or increasing the wages of these employees. Also, Jerome Powell stated that the unemployment rate has been steady since the middle of last year and at 4% in January, which means that the overall unemployment rate remains low. However, from an inflation perspective, things might not be getting better, as Jerome Powell stated that the total personal consumption expenditures, or the PCE prices, has rose around 2.6% over the 12-month period ending in December 2024. Moving on to the next section of his testimony, he talked about the monetary policy. As you might remember before, the intro of his statement is that our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. This means that employment and inflation plays a huge role, which is why both of those data were highlighted in his earlier statement. However, there is a statement that can be highlighted to determine whether the US interest rate will go down or not. The statement is that if the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. This means that the US interest rate can only go down if the US employment data gets better or if the inflation were to be lowered. Also, Jerome Powell stated that we are attentive to the risks to both sides of our dual mandate, and policy is well positioned to deal with the risks and uncertainties that we face. In this statement, uncertainties translates to the economic uncertainty that is currently happening in the United States, one of the factors being Donald Trump's new tariff policy. Overall, if you're interested towards the full testimony, you can access it here, or just go to the tweet and click this link.